In this lesson, we'll explain what the Fibonacci Retracement tool is, how it works, and how traders use it in Forex. For weekly market breakdowns and actionable trading insights, don't forget to subscribe to the Blueberry YouTube channel. Understanding the Fibonacci Retracement tool. The Fibonacci Retracement tool is widely used in technical analysis to identify potential support and resistance levels during a pullback. It is based on a sequence of numbers identified by mathematician Leonardo Fibonacci in the 13th century. What matters most for traders is not the sequence itself, but the ratios derived from it. The key ratios commonly used in trading are 23.6%, 38.2%, 50%, 61.8%, 78.6%. These levels are applied directly to price charts. How Fibonacci retracement works. To use the Fibonacci retracement tool, traders select two significant points on a chart. This is typically a major swing high and a major swing low. The tool then divides the vertical distance between those 2 points into the key Fibonacci ratios. Horizontal levels are automatically plotted on the chart. These levels act as potential areas where price may pause, retrace, or reverse. For example, if price moves upward and then pulls back to the 38.2% level before bouncing higher, that level may act as support. If price retraces upward during a downtrend and stalls near the 61.8% level, that level may act as resistance. How traders use Fibonacci levels. Fibonacci retracement levels help traders identify potential pullback zones, plan entry points, set stop-loss placements, estimate areas where trends may resume. For instance, if a strong uptrend retraces to the 61.8% level and forms a bullish candlestick pattern, some traders may view that as a potential continuation opportunity. However, Fibonacci levels are not signals on their own. They highlight areas of interest, not guaranteed reversal points. Fibonacci extensions. Beyond retracements, traders also use Fibonacci extensions. Extensions project how far price may move beyond the original swing high or swing low. Common extension levels include 127.2%, 161.8%, 261.8%. These levels are often used to identify potential profit targets during trending markets. Using Fibonacci with other tools. Like all technical tools, Fibonacci retracement works best when combined with other forms of analysis. For example, a Fibonacci level aligning with a key support zone, a retracement level forming near a trend line, a Fibonacci level confirmed by a reversal candlestick pattern. When multiple factors align, the level may carry greater significance. Fibonacci retracement is a framework for measuring pullbacks within trends. It does not predict the future, but it can help structure trade planning and risk management. If you'd like to apply what you've learned in a practice setting, you can open a free Blueberry demo account to trade in a simulated market environment. Follow Blueberry for more educational videos and actionable trading insights designed to support your trading journey.